Worse than recession. You're saying this is reminiscent of the 1930s. We should tell our viewers you correctly predicted the 2008 financial crisis. What is your prediction for where the country is headed right now?
What if I told you that every single financial catastrophe in history followed the exact same playbook? The 2008 housing collapse that wiped out $7.4 trillion in stock market value, the Great Depression that left 15 million Americans jobless and banks closing their doors forever, the dot-com crash that vaporized $5 trillion in market cap in just 2 years.
A recession is 2 negative quarters of GDP, and whether it goes slightly there, we always have those things. We have something that's much more profound. We have a breaking down of the monetary order. We are going to change the monetary order because we cannot spend the amounts of money, so we have that problem. And when we talk about the dollar and we talk about tariffs, we have that. We are having profound changes in our domestic order, how ruling is existing, and we're having profound changes in the world order. Such times are very much like the 1930s. I've studied history, and this repeats over and over again. So if you take tariffs, if you take debt, if you take the rising power challenging the existing power, if you take those factors and look at the factors, those changes in the orders, the systems, are very, very disruptive. How that's handled could produce something that is much worse than a recession, or it could be handled well.
These weren't random events. They were predictable disasters with crystal clear warning signs that most people completely ignored. And right now, as you're watching this video, those same warning signs are flashing red all around us. If you're serious about protecting your financial future and never want to be caught off guard by the next economic meltdown, then you need to watch this entire video, because by the end, you'll know exactly what to look for and how to position yourself before it's too late. Don't be the person who says, "I wish I had known," when the next crisis hits. Stay until the end. Your future self will thank you. Hey everyone, I'm back with another deep dive into the financial world. And today we're talking about something that could literally save your financial life. If you find this information valuable and it helps you see the bigger picture, smash that like button and subscribe, because this is the kind of content that could change everything for you. Now, here's what most people don't understand. There's a massive difference between a regular recession and a full-blown financial crisis. And knowing this difference could be the key to protecting everything you've worked for. Understanding the difference, bubble versus recession versus financial crisis. Let me break this down for you because this is crucial. Most people think these terms are interchangeable, but they're not even close. A bubble bursting is like the dot-com crash of 2000. Remember all those companies with .com in their name that had zero profits but sky-high stock prices? When reality hit, those stocks crashed hard. People lost money, sure, but it wasn't a global catastrophe. A recession is just 2 consecutive quarters of negative economic growth. It's uncomfortable. Jobs might be harder to find, but it's not devastating. The Federal Reserve can usually fix it by lowering interest rates, money flows again, and we're back to normal. But a financial crisis, that's when the entire financial system breaks down. Banks fail, people lose their homes, savings disappear, and the effects ripple across the globe for years. This is what we're talking about today.
I want to be very specific about what you mean. You're saying worse than recession. You're saying this is reminiscent of the 1930s. We should tell our viewers you correctly predicted the 2008 financial crisis. What is your prediction for where the country is headed right now?
Right now, we're at a juncture. Let's take the budget. If the budget deficit can be reduced to 3% of GDP, it will be about 7% if things are not changed. If it could be reduced to about 3% of GDP, and these trade deficits and so on are managed in the right way, this could all be managed very well. I believe that members of Congress should take the pledge, what I call the 3% pledge, that in one way or another, that they will get that budget deficit down to that number. If they don't, we're going to have a supply-demand problem for debt, at the same time as we have these other problems. And the results of that will be worse than a normal recession.
So, and just to follow up on that point, worse than a recession, you're talking about the 1930s. What specifically are you warning of? Are you saying that it could be as bad as a depression? What's your biggest fear?
The value of money. What is a storehold of wealth? That is a bond. In other words, one man's debt is another man's assets, bondholders. And so we're going to be in a situation where if that storehold of wealth is in jeopardy because there's too much supply and demand and so on, and we have a monetary inflation, we will have great disruptions. And that could be like the breakdown of the monetary system in 71. It could be like 2008. It's going to be very severe. I think it could be more severe than those if these other matters simultaneously occur.
The anatomy of a financial crisis. Here's the pattern that shows up every single time, and I mean every time. It starts with a bubble, just like any other market cycle. People get excited about an asset, stocks in 1929, houses in 2008, tulips in the 1600s, prices go up, everyone thinks they're a genius, and FOMO kicks in hard. But here's where it gets dangerous. People start buying these assets with borrowed money, not just a little leverage, massive amounts of debt. They convince themselves that prices can only go up. So borrowing money to buy more makes perfect sense. Then comes the confidence shift. Almost overnight, people realize prices are insane. Selling begins. But here's the problem. Everyone who bought with debt can't afford to hold on. They're forced to sell at any price, which creates a downward spiral that destroys entire economies. The clearest warning sign? When your barber, your Uber driver, and your neighbor's teenager are all giving you investment advice about the same asset. When the least sophisticated investors pile in with borrowed money, that's your cue to run. Historical warning signs, speculation patterns. Let me tell you about the most famous bubble in history, the Dutch tulip craze of 1637. Yes, people literally went crazy buying flowers. At the peak, a single tulip bulb cost more than a luxury house in Amsterdam. People were trading tulip futures, contracts to buy flowers that hadn't even bloomed yet. Sound familiar? It should, because the same psychology drives every bubble. When people start buying something not for its practical value, but because they think someone else will pay more for it later, that's pure speculation. Bitcoin is showing similar patterns right now. I'm not saying Bitcoin is worthless, but when people are taking out second mortgages to buy cryptocurrency because it only goes up, that's the same mindset that drove people to bankruptcy buying tulip bulbs. The lesson is simple. Markets driven by speculation are ticking time bombs. Whether it's tulips, tech stocks, or digital currencies, when the crowd goes crazy, smart money gets out. The gold market warning signs. Here's something most people don't know about gold, and it could save you a fortune. Gold doesn't actually protect against inflation like everyone claims. It protects against fear. Here's the pattern. When consumer confidence crashes, gold prices spike. People panic, buy gold, and prices keep rising even after the crisis passes because fear lingers. But eventually, confidence returns, people stop panic buying gold, and prices come crashing down. I've seen this cycle repeat over and over. Right after a major crisis, everyone's screaming, buy gold, buy gold. But that's usually the worst time to buy because you're paying panic prices. The smart play, set a fixed percentage for gold in your portfolio, maybe 5%. When gold rises and exceeds that percentage, sell some. When it falls below, buy more. You'll be buying low and selling high while everyone else does the opposite. The Roaring '20s. The 1920s were incredible. The economy was booming, new technologies were everywhere, and everyone was getting rich in the stock market. Sound familiar? It should. But underneath the party, something dangerous was building. People weren't just buying stocks with their savings. They were buying on margin, meaning they borrowed money to buy more stocks. Some people were borrowing 90% of the purchase price. The thinking was simple. Stocks only go up, so borrowing money to buy more is free money. When stock prices doubled, people who bought on margin made 20 times their initial investment. It seemed like magic until October 1929, when reality hit. Stock prices started falling, margin calls began, and people who had borrowed money were forced to sell at any price. This created a death spiral that didn't stop until the market lost 89% of its value. The lesson: speculation creates bubbles, but debt creates financial crises. The 2008 housing bubble, history repeating. People learned from 1929. They stopped buying stocks on margin, but they didn't learn the real lesson. Instead of avoiding debt-fueled speculation entirely, they just found a new asset to speculate on: houses. Real estate always goes up. They're not making any more land. Everyone needs a place to live. These became the new mantras, just like stocks always go up in the 1920s. Banks started offering ninja loans. No income, no job, no assets required. People bought houses with zero money down, planning to flip them in 6 months. Some people owned 5 or 6 houses they couldn't afford, all bought with borrowed money. The result? When house prices started falling, over 3.7 million homes went into foreclosure. Major banks collapsed. The global economy nearly broke. Same pattern, different asset. Speculation plus debt equals disaster. How financial bubbles burst. Bubbles don't deflate slowly, they explode. One day everyone's buying, the next day everyone's selling, and there are no buyers left. Black Tuesday, October 29th, 1929. The market opened to massive selling pressure, but nobody wanted to buy. Stocks that had been trading at $100 couldn't find buyers at $50, then $25, then $10. 2008 was similar. Houses that had been selling in days sat on the market for months. Prices fell 30%, then 50% in some areas. People owed more on their mortgages than their houses were worth. The pattern is always the same: euphoria, then panic, then collapse. The only question is timing. Can we predict the next financial crisis? Here's the honest truth. We can't predict exactly when the next crisis will hit, but we can see the warning signs building. Right now, I'm watching several concerning trends. Cryptocurrency speculation reminds me of the dot-com bubble. Some real estate markets are showing 2006 level craziness. And yes, people are borrowing money to buy speculative assets again. But here's what's different. Information spreads instantly now. Social media can turn a small trend into a global phenomenon overnight. This means bubbles might form faster and burst more violently than ever before. The good news: if you know what to look for, you can protect yourself. Protecting yourself, the two-step defense. There are only 2 things you need to do to protect yourself from financial crises, and they're surprisingly simple. Step 1, diversify everything. Don't put all your money in any single asset, no matter how sure it seems. I recommend studying Ray Dalio's all-weather portfolio strategy. It's designed to perform well in any economic environment, including financial crises. Step 2, eliminate debt. This is the big one. Debt is what turns market downturns into personal disasters. If you don't owe money, you can ride out any storm. If you're leveraged to the hilt, you'll get wiped out with everyone else. The only debt I'd consider acceptable is a mortgage on your primary residence, and even then, pay it off as fast as possible. The secret weapon: financial education. Here's your real advantage: financial literacy. Most people are financially illiterate, which is why they keep making the same mistakes generation after generation. Spend 15 minutes every day learning about money, investing, and economic history. Read the classics, Think and Grow Rich, anything by Warren Buffett, Ray Dalio's Principles. Understand how real investors think. Knowledge is your shield against financial disaster. When you understand the patterns, you won't be the person buying tulips at the peak or houses with no money down. The inevitable truth. Here's what I need you to understand. The next financial crisis isn't a question of if, it's a question of when. History shows us that these cycles are inevitable. Human nature doesn't change. Greed and fear still drive markets just like they did 100 years ago. But now you have something most people don't: awareness. You know the warning signs. You understand the difference between speculation and investment. You know that debt amplifies both gains and losses. So here's my challenge to you. Don't be a victim of the next financial crisis. Spot the signs before they become obvious to everyone else. Don't follow risky trends just because everyone else is doing it. Learn from history instead of repeating it. Stay ahead of the crowd, stay educated, and most importantly, stay prepared. Financial literacy isn't just about making money, it's about keeping the money you make. If this video opened your eyes to something you hadn't considered before, hit that like button and subscribe for more content that could literally change your financial future. And tell me in the comments, do you think we're headed for another major financial crisis, or are we just looking at a regular recession on the horizon? Remember, yesterday's tulips could be today's cryptocurrency or tomorrow's whatever the crowd is buying. The next crisis is coming. The question is, will you be ready for it? Thanks for watching, and I'll see you in the next video where we'll dive even deeper into protecting and building your wealth in uncertain times.